Hi, I'm Peter Andresen with Andresen and Associates. We are fee-only investment advisors in Salinas, California, and I am making this video for my clients to discuss what's going on. Of course, it's not pleasant. The stock markets are going down, interest rates are going up, but it's also expected, isn't it? We've discussed the fact that this was a probable situation, and here we are back testing those June lows. So let's take a deep cleansing breath. You know, I said that to my wife one time and while she was giving birth, and she almost bit my hand off. So I'm hoping that we're in a better frame of mind today. Nevertheless, it is a stressful moment. What the Federal Reserve interest rate means to us, what the Federal Reserve interest rate increases mean to us, again, not unexpected, but not necessarily pleasant in the short run. It's also incredible opportunity. But what this we got to really think about. What I'm about to discuss is based on historical performances of financial markets and what I think is going to happen. Best estimates. We never know if what we think is going to happen will actually happen because surprises are routine. But we kind of see the trend, don't we? We can see mostly what's going on out there. Nevertheless, change and unexpected events are normal, sometimes fast and sometimes slow. I've noticed that change tends to happen not very much and then all of a sudden in a rush. But these changes also represent opportunities, and they are going to shape up to big opportunities now. At least that's what history tells us. Please keep in mind that everything I'm discussing involves uncertainty and risk of loss. Things can go down as well as up. That is especially true if we panic. And so right now is one of those moments that we encounter in life. Everybody thinks we have courage until we're faced with a real challenge. A few days ago, in response to surging inflation, the United States Central Bank, that's the Central Reserve, raised a key short-term interest rate. Now, not unexpected. Again, this is an expected thing. As you can see, this happens whenever the economy begins to get rather hot. This is not a new thing. The Federal Reserve has done this a lot of times, and there's usually something that happens when such an increase occurs. The changes themselves are rather large. It's a 0.75% interest rate, but we're not in an historically high interest rate, not even close, not even remotely close. Now, if you look at here, you'll see that in 2000, right before 2000, when interest rate increases like this happen, what are they almost always followed by? They're almost always followed by recessions in a way that's intentional to slow the economy down. Recessions are not pretty. What happens when recessions happen? Interest rates go down. And that's likely to happen here as well. So media notwithstanding, we are probably not looking at interest rate increases as far as the eye can see. For one thing, corporate refinancing is going to get caught up in this, and that's the unseen elephant with big tusks in the room. And when that happens, economic slowdown is likely because refunding costs are going to be huge. Now, this has been brutal for the bond markets. That's the thing that we all are not used to because you and I haven't experienced this in 30 years. Historically, it's happened, but a Schwab U.S. Aggregate Bond Index Fund dropping 15% in the past year is unprecedented for all of us who are investors. It has happened in the past. We'll get into what's going to happen next after this. Bonds go down as interest rates rise because, remember, bonds are fixed income. So interest rates go up, bonds go down in short-term market value. They tend to go up in value as interest rates go down. Shorter maturities move less Now, we moved most of our money to shorter maturities in the bond market. They still lost money, but not as catastrophically as the larger maturities. Those longer maturities move a lot, especially if the coupon is low, like it has been. There's also an issue in bonds for credit quality, which is another topic. I'll discuss that in coming months. But right now, that's not the issue. The issue is interest rates moving. What happens when bond markets lose money? Since bond mutual fund investors tend to be in it for the income, they tend to recoil at the loss and they tend to sell. This is really interesting. Morningstar did this. They did a study. Over the 10 years ending December 31st, 2021, these bond mutual funds that were studied made 3.58%, but most investors, the average investor only made 2.41 because they were hopscotching around, recoiling, selling out of bond markets, going to cash. So we don't want to do that. We do not want to go to cash right now. Better to wait it out. If the expected recession occurs because bond interest rate increases, especially driven by the Federal Reserve, tend to be accompanied eventually by a recession. And then what happens? Interest rates go down. This is a graph of interest rates. So you can see we're not even remotely close to historically high interest rates. But interest rates fall during recessions. And when that happens, what's going to happen? Bonds are going to go up. So we are going to ride this interest rate surge until bond interest rates go down, and then bonds will go up. So it's something we haven't experienced lately. In the last 10 years or more, interest rates have been ridiculously, abnormally, artificially low. And so right now, the bond markets are in a state of shock. Yields on the corporate side are at 12-year highs. So historically, we have seen this before, but not recently. Stock market performance year to date has also been down, but not yet horrible. That may change. That's because in the mutual fund sector, in the equity side, investors are thinking this is a speed bump. They're not yet pricing in a recession, in my opinion. They think that this is all about simply rising interest rates. They think we're going to avoid a recession, although historically, we already know that when you have rising interest rates like this driven by the Federal Reserve, a soft landing is extremely rare. So a recession is now likely. The stock market is pricing that in right now. Today, I think the stock market's down about 2%. We started this year in a relatively lower risk posture. The situation may change radically, which is why I did not just go to cash. However, my perception is that the stock market has a decent chance of going down from here. As you can see, small growth it has truly been hammered. And large growth is also down over 25%. I'm looking at clients bringing to me their investments from elsewhere, and they've got entire portfolios down 28%, which is normal if you've packed it full of large growth, and it's survivable. It's just not pleasant. The stock markets are not cheap right now. They are not pricing in the odds of a recession. If you look at these, this rainbow here is a gaggle of stock market valuation indicators. Red means overvalued, green means fairly valued. If you look at it relative to history, most of these indicators, most of these statistical check marks that you have to see how valued the stock market is, they're all saying that the stock, not all, but most of them are saying that the stock market is still fairly overvalued. And that implies that we may go down from here more. Meanwhile, international stock markets are reflecting low expectations. They're already pricing in recessions. They're cheap. So combined with the current very strong dollar, which is at 30-year highs, the international stock markets look more attractive for new purchases, at least for now. Now, my guess, and this is just my guess, total guess, we have to point the boat somewhere, don't we? So I'm pointing the boat in this direction. First recession in Europe due to the Ukraine war, which is a wild card, by the way. Second recession, Asia, as European consumers dry up. Third recession, United States. This could even take until 2024 to evolve, if it happens at all. We may escape recession, who knows? But that's my expectation, and that's why I'm not rushing to buy equities. I could be wrong. The stock market may recover quickly. We may not have a recession. If that's the case, we've got other fish to fry, other issues, but that's why we're not in cash, because historically that change happens without any notice. Meanwhile, I expect more turbulence and probably, but not certainly, a global recession somewhere out there, 2022 to 2024. We may be in it, the leading edge of the storm right now. I expect to gently cultivate bond funds to slightly extend the maturities and enhance credit quality. Why am I doing that? Because if interest rates are going to go down, we want to be in the longer maturities to capture more of that gain. And we want to enhance credit quality because a recession is likely to test credit quality issues. I'm moving more towards active mutual funds versus index, because the index is not going to be able to, of course, it's an index. It's not going to be able to get out of its own way. I'm going to maintain current cautious. I mean, we are taking losses, but I'm cautious. I'm going to maintain current cautious stock market exposure because I don't know what's going to happen. And I want to be able to not lose a lot if the stock market continues to decline, but I also don't want to miss out if the recovery happens and we're not fully aware of it. When opportunities emerge, I am going to move from bonds to stocks. My perception is that we're going to make most of our recovery money on the equity side, which historically is certainly out there somewhere. Those bargains don't exist yet. I'm going to focus on international and dividend and small when that recovery occurs. I've really been thinking about this a lot lately. Change for all of us, if only hair loss or whatever, is unavoidable and inevitable. Ask my dentist. Yet we tend to approach change, we all do, with fear because we don't know what's out there. Anger, we want to blame somebody. Look at the political turmoil. This is a recession. It's been 15 years in the making. It's not all about politics, but we want to blame somebody. And we feel guilty because I should have seen that coming and gone 100% to cash. But you can't. That's the very nature of change, is that you can't fully anticipate it. But the reality in our own lives, change often brings opportunity. Fighting our own minds is part of that success. So history is telling us, if we line up all the little numbers, that one of the great bargain times of history may lie ahead. And I don't want to miss it. I don't want to miss it for you, and I don't want to miss it for me. This is going to be big. So for now, patience, time, discipline, and consistency. Stay the course. Blessings. Enjoy our fall.